Hello, everybody. It's Greg. So we got what we were looking for last week. Came at the end of the week. FOMC meeting on Wednesday got out of the way. There was some intraday dips, and it closed okay, but still within a range. Then Thursday, prices took off out of this bottoming pattern. I was kind of hopeful, I was hopeful that it would come down here and tag that low again, but it made a higher low, and it just hung there. And then as the news came out, lead institution said coast is clear. FOMC minutes suggesting, they'll do the 50 basis points, but they weren't thinking about being more aggressive. So that what was considered a worser scenario out of the way, institutions bought hand over fist. And what we got, we looked for our technical confirmation of real buying, and we got that AD line to close above 2,000, decently above 2,000. If this was coming from a correction where prices had been bottoming out for a while, and we can see that through just the price action, of course, but prior times in history, big moves come when after an initial move happens and moving averages, which we call visual aids, kind of come down under prices. Now, at least we have an initial move above the 20 MA. It's a start. Here, down below. Here it was down below. And this was this move that happened back here in March as it was retesting these lows here. And notice while this did get up and just, I don't even know if it got to 2,000, but close enough there. Probably intraday it didn't close there. But this buying was stronger. Now, does that mean we're going to have the same size of a move that we did here? Well, maybe, but we can't be absolutely sure. One of the takeaways from here is that these areas of resistance should be less powerful now than they were before. Meaning after the initial start of a move like this where institutions are now showing that they're committed, they're going to buy dips. What we would like to see now, ideally, is not something like this that runs too far too fast. What we would like to see is this kind of a correction bar arrangement of bars, like bar by bar, where it attempts to go down and then flips back up again. Now, the sooner it does that, the more ideal the scenario is to potentially take advantage of what's possible here on the upside. Moving averages, there could be stall points. That red one is the 200. You see it sliced right through the 50 like it wasn't there. So the 50 wasn't aligned exactly with that high there, but it did stall. Notice the small bar right there where the opens and closes are the same. That tells us that momentum slowed, but it never broke a prior bar's low. Prior bar's low is our first reference point of support. And so as prices are moving up and prices will appear, well, they won't appear, they will be extended on a short-term basis. Now, getting extended from a consolidation isn't as getting extended bar by bar after a second move up and sometimes a third move up. The further prices get away from any price support, the greater the probability for a greater retracement. Common sense. And so here prices had gapped up and then they came right back down again and started the move. So the ideal scenario that we would like to see this week would be, and again, the sooner the better, let's say Monday starts out with a red bar, and then the next day, possibly, it trades under it and we get a green bar. And that would be, hey, all in time, because we've got a correction bar or a series of correction bars coming together that, in this case, what I drew here, what we would call a bear sandwich. And I always get a little confused with that because the words bear sandwich being bullish and vice versa, but that's the way Dan coined it. The meat in the middle is the red bar is the bear, which is bullish. So now, what are our upside targets? If this shoots straight up Monday, Tuesday, and hits the 50 MA, which is aligned with this pivot here, I think it probably stalls, and then we see if it pulls back. Now, upside target one would be that 50 MA, which should be, we use the word no-brainer, meaning it should happen without little to any doubt because of what I just explained and the initial move up in the power coming down into this support area. Now, a higher level, which is possible, and I put the 100 MA here, which is equivalent to the 20 MA on the weekly time frame, which is in a downtrend. And that'll be a reference point to those looking at the weekly time frame. But there's little to nothing to the left, as you can see here. However, the 200 MA, that's about 7% from Friday's high, which would be a really nice move. And that would be what we would target as long as we continue to get bullish price action on the way up. So, for example, you get another red bar or some kind of bearish bar. I mean, it could be a bottoming tail bar that might form, bottoming tail bar, and then it continues up, so on and so forth, into getting up toward this larger targeted area at 4,500. Now, of course, it's got to get through 4,300. It's got to get through 4,400. And, of course, there'll be wiggles intraday all over the place. That being said, from a higher time frame point of view, we'll be looking at the daily and the weekly. What does this communicate to us as it continues to move up from here? As it's going up, apply our systematic method. What is the prior bar's low? What is the prior bar's low? We're getting close to a targeted area. What is the prior bar's low? What happens there? Does it trade under the prior bar's low? And if it does it flip right back up again? Which will communicate to us that there are buyers on the dip and they are aggressive and supporting a bias that it could potentially get up here. And I don't want to say it will get up there because no one knows for sure. But as we apply our method, it'll guide us along the way. So if it breaks a prior bar's low and springs back up, that's a good thing. If it consolidates a little bit and then flips back up again, we'll view that as a continuation type of a pattern. And we'll then see, the 50 being under prices, the 100 will come down. And so the moving averages being these visual aids, they kind of guide us as to this picture that we'll be viewing on a continuous basis. And as it moves up and higher prices get averaged in and older prices get dropped off, the moving averages will begin to change the picture to one of being slightly bullish initially here, bearish up here, some neutral kind of price action, and the ebbs and flows that however they're going to happen to repairing this damage, that'll have to happen over a longer period of time. Right? The prior corrections, if we scroll back, prior years where there were these pullbacks and moves off of lows, prices were above these longer term moving averages. It's easy to break below the 20. It's relatively close, and there are those that look at a 10 or possibly an 8 or whatever they choose to look at. The lower the value of your moving average, the closer it is going to be to prices and the easier it is to break. Now, the 50 MA is equal to the 10 MA on the weekly. The 100 is equal to the 20 MA on the weekly. So this tells us that the weekly at this time was trending up. You can see the slope of the moving averages and the distance between those two moving averages and the relationship between them, the 50 above the 100, both of them above the 200. So this market environment that had a move off of a low, very different than this one currently. And this one had a deeper correction, and it was pointing down, and that's what started this move off of the low that eventually went back down. So what we see here is something to keep in mind, that whatever happens here, it could result in another wave to the downside that takes out this low. We don't know if that'll happen. We'll see how this evolves and what it looks like on higher time frames. And again, we can scroll back to different points in time where there were bigger corrections. And here, look at the spike there off of the low. Good sign. Didn't mean it couldn't come down here and take out the low and start to rebuild again. Different times, different market environments, different patterns. But here we've got a nice wide range bar coming off of this type of a bottoming pattern there. So that looking really good. So again, big tag, up above 2,000, but above all the moving averages. You get the idea. This has the potential to go up, but don't relate this internal market gauge to suggest the same thing to an extent that it did in the past. This market has been going through a larger correction. And there's overhead supply. So let's take a look at some other charts as we always do. Decent moves in the broader markets last week. S&P's cleared the prior pivot high. 50 MA looks like a bund from here. Qs just barely got above it. They have been underperforming. Maybe that's where the greater potential is, since it's a further distance to its first area of price resistance. The transports are right there. They weren't able to clear that, so showing relative weakness. Again, moving averages pointing down, pointing down, pointing down, pointing down on the Russell. Should be able to get up to the 50, which is aligned with that pivot. Let's take a look at the weekly time frames. And we've got wide range bars. So anytime we see a wide range bar, the ideal scenario is for it to stay in the upper half of that bar with any type of corrections. So we want to see the spider stay above 400 and close above 400. If it pokes down there, we want to see it spring back up again. What we don't want to see this week definitely would be a red bar that goes deep and closes deep into last week's bar. While this is in a downtrend, that is a real possibility, right? Less so because of the internal gauge that we just covered, but the trend is the most important thing. Internals can guide us to the power of a reversal, which is great. But, and if sellers are aggressive, some bearish news comes out, that could happen. Now, which could result in a big flip-flop kind of situation because prices are down quite a bit. It's not a no-brainer scenario here because this is just a 2-bar reversal, but even if that happened, getting a bear sandwich on the weekly time frame, I think, would be an amazing signal. Look, all of that being said, what should happen is a move up into this area here where it stalls, and then prices begin to falter, and then, hey, if new lows are in the cards from there, we'll have to assess that at the time. Right now, we got internal gauges showing power on that reversal. We've got some room to move up. We'll just see how it plays out. Transports here had broken down under some support. It came down to next support. We got a reversal. And everywhere we look, still from a intermediate to longer term point of view, things are still bearish trends, but we've got a situation here where we could get a decent size bounce. So we'll see how this plays out this week. Our market internals, sentiment has a little bit more room before hitting those upper bands. And breadth here is way up at a high level, which is a positive. It tells us cautious on a short-term basis, but the fact that it was able to get that high shows institutional participation, and that's what we wanted to see. However, when this gets up here, and I suspect should this push up toward that 50 MA, option traders will be buying more calls, a lot more than puts, and this will push up into this area, and you're going to get some kind of corrective price action. I'll say it again, though. The fact that breadth was able to get this high is a positive. And so we'll look, hopefully, getting some kind of correction bar or corrective type patterns that support long entry points for prices to continue to push up and potentially above these swings up here, right in that area. And we can put the price there, which just shows, right around 4,300. It says 4,290, give or take, but 4,300 right up there is where it's going to run into a bunch of sellers. And if it goes straight up there on Monday, Tuesday, you can be sure it's going to hit a wall because that'll be too far, too fast. All right, looking at other markets, utilities, coming around. And I thought to myself, when I saw utilities continuing to perform well, why are institutions coming here when they could be buying tech stocks or certain things beaten down that could outperform this in a huge way? So there's still some defensive buying going on here, which is also supported by the fact that maybe they were just cheap, but they came and bought the consumer staples in a big way that got creamed the prior week. The Walmart and Target and a whole bunch of other stuff, Coca-Cola, McDonald's, all those stocks got creamed and they came ripping back last week. Communications, this has been a big underperformer. It's down a whole heck of a lot. I don't know if it's time to buy this yet. So we'll see what this does. At least it's got a bottoming tail bar here that took out the lows. So we'll keep an eye on that. I think everything, for the most part, is likely to hit a bit of a wall this week, and they moved up a bunch because they're all in downtrends, and then we'll see how much they pull back, and that'll really allow us to assess the strength. We know that there's strength. We know institutions want to buy based on internal gauges. What will they do today? Meaning they were that way this week. We've seen them flip-flop time and time again, like day traders from one day to the next. The internal gauge is getting as high as they have. It is different, so we expect that they will be buying dips. We just now to see it for sure. Biotech really didn't perform very well last week, and we talked about the week before that it is down here, so I'm a little surprised that it didn't. But another dip here, and I think that this is something that should be bought. I mean, if it breaks down under here and we get a reversal because of the support area that it's in, I think a nibble there would be timely. Not anxious to get all in at one time. Another thing we talked about 2 weeks ago was that this was stabilizing. And I talked about maybe this was close to a low because, and it didn't happen right away, because interest rates had reached the area that we said, look, if they get up here, they're likely to start coming back down. And that's what happened. And when interest rates start to back off a bit, you have home builders and construction stocks that start to do better. So it dipped down, it made a new low, and it came back up again. They're still in downtrends, but these are stocks that may start to find some buyers. I'm just looking. Lenore, you see, that's a big part of that. But like Home Depot, that's never going out of business. Downtrend, but look at the moving averages here getting tighter together. So it broke down, it came back up again. Let's look at the weekly time frame, see where it's at, kind of close. So if we get another rollover in the markets and Home Depot came down here and we start getting the same kind of bottoming pattern, that would be great. Now, let me just say, it doesn't have to go down there. We have a concept called creating support or creating resistance. And so pivot, retest pivot, this is created support. While the support from the past is over below and down to the left, it doesn't mean it has to go down there. More bottoming price action would be just what we would want to see. Right? There's plenty of resistance here, but little consolidation, the moving averages catching up a little bit more as this bottoms out, and I think this would be another good buying opportunity. It is a victim of high interest rates, and of course, prices go up, construction prices go up, mortgages go up, business slows down, and that's what happens. Metals and mining coming back up again. It held this support, and 50 MA is up there. As you can see, it's above the 200. It's above the 100. The 50 is up here, so it's stronger than many other things. We could go and look at stocks within that. U.S. Steel, but it looked just like that with a rounding bottom and started popping up. Here, pharmaceuticals. Got to go to the weekly chart. We talked the fact that it was coming down into this area. It's in a downtrend. Now, I don't know what's in this sector. Maybe some other biotechs, I suspect, because some pharmaceuticals have been doing really well. Like Merck looks good, and Pfizer, not as good. J&J actually looks pretty good. Little buy setup there, and what I liked about this last week, while it didn't rocket up like some other things, that's okay. It went sideways and had a nice bottoming tail type of bar going sideways there. So clearing here, it should be able to go up. And retailing, right? This was a big part of the bearishness. Well, for a while, breakout failure. We talked about this in various letters in this breakdown and had this reversal last week. So we'll see if this can continue to repair the damage, but it is in a downtrend still. So really not interested in trends like this until they do some kind of retesting and bottoming action. Now, semiconductors, they led the way down. High interest rates, bad for tech, bad for semiconductors. We've all heard about the semiconductor shortage, no cars available, and so on and so forth. Now, about a week or so ago, I started seeing in certain stocks some relative strength in semiconductor stocks. And then they fell apart again as the market pulled in. And, that is what bottoming process is. I use the word treacherous, and it just flipped back and forth. However, let's go to the weekly time frame. And we see these semiconductors down here at this pivot low, and buyers stepped up. And look, some people say technical analysis doesn't work. But how many times can you look to the left and see buyers step up and not recognize that institutions are looking to the left? While they talk about fib lines, trend lines, Gann lines, Elliott wave extensions. In the closet, they talk about, hey, did you look to the left and see that support is over there? And I keep talking about that esoteric stuff to keep the masses confused. And that's the kind of, I'll use the word crap, that you hear in webinars all over the place, indicators and esoteric analysis at Master Trader. You just look to the left. There's nothing proprietary. You see support areas. Buyers are going to show up there again. And then we just see what they actually do when they get there. So this is still in a downtrend. It's bottoming out here. It's still got work to do. But it's encouraging that this sector, which supplies so much technology to different things in our lives, looks like it's beginning to repair the damage. Software. This got killed. It led the way down, and there's a lot of stocks that have been decimated within this sector. And look to the left. Just like everything else, it's got work to do to repair this damage. It's down a whole lot. So let's see if it can bottom out here. It had this consolidation and it's gotten above. Now, these bottoming stocks, while this looks like it can go up here, tracking a prior bar's low, you can't give them a whole lot of room. Well, you have two choices. You either got to give them a whole lot of room and give back a whole lot, or potentially turn it into a loser because it's in a downtrend. Now, you can see the distance between the moving averages. It got a little extended. So you can see the distance here versus the distance here. As you can see here, it was more of a controlled move to the downside. And now, big fast drop, which opens up the door to a little bit larger move up. Maybe it'll get up there. We shall see. But don't fall in love with these. Don't chase them. They're going to come down again. Absolutely for sure. And they all do. They have to just bottom out a little bit more. Just extend it to the downside. It's a little kind of like semi-climactic move lower where you can get a tradable bounce. And that's basically everything that's happening in the market right now. A tradable bounce, and we'll see how far it gets. Telecom, all right, broke down same way, and it's bouncing back up again. Consumer discretionary. This is one of the biggest winners last week, believe it or not, because this is one of the worst performers this year, if not the worst performer in the S&P 500 sectors. But you see it actually pushed down below here. It tried to hold. You can see right there, it tried to hold. And this is what I was hoping the broader markets would do, where they tried to hold and then break lower. They didn't, and then spring right back up again, because this is a typical pattern where it just breaks one more time and then comes right back up again. So this is another good sign for the broader markets. You can see the distance between the moving averages are far apart. It could bounce further, and we'll go through a bottoming process. So this is going to take time to repair this damage. So, just a thought. The rest of this year could be a lot of backing and filling and some decent rallies from now, and then coming way back down again as we come into September, October, where the markets get smashed again, and the end of the year and so on. So there's a lot of time ahead for us to see what's happening in the markets and looking to take advantage of that. Consumer staples, I already showed you the collapse and the retracement. Energy has just been doing amazing. It stalled around that $80 area that we had talked about in the past. And, oil, even though oil is flat, being as high as it is, it supports these stocks because just high oil prices means they are making money. It looks like this should continue to go up. And looking at crude oil, you can see here, it's a continuous contract. That's why it's got this blip to the downside at one point. It was a negative. That was an amazing time. But this continues to be bullish. It got all whippy here, but it didn't break down. Daily chart just looks like it's ready to, if it clears these highs, to push up. And those oil stocks could go into a parabolic climactic move to the upside if oil was to break out here. And of course, that's going to ignite inflation fears. So while we're talking short-term bullishness, if this runs up, I don't think that that'll put the brakes on institutions buying. However, if this should push up and we see the 5-year come off of this little downturn and flip right back up again, and the 10-year flip right back up again, which markets has liked them rolling back over, and we see the dollar, which is pulled back, rip right back up again, you're going to keep an eye on the exit door. So these are some things to keep an eye on there, as far as maybe the market's not doing what they appear that they're going to do. Financials, which came off of the low very nicely, but they broke down recently. We talked about this big rounding top and the breakdown, which is bearish. At some point, there's going to be sellers in here again, but this could rally up into this area up here. So we'll see. If it can't get through 36 and rolls right back down again, that could be another piece of information to suggest the S&Ps are not going to move up that far as they might. So if this pushes up through 36 and through the 50, view that as bullish information for the broader markets. Healthcare, trading range, came down to the bottom of the trading range, coming back up. Tends to be a big mess here, but showing relative strength. Industrials, same story. Moving average trend down, moving averages pointing down, and so on. Materials, some relative strength. Specialty chemical stocks have been doing well. So while this is a big mess, if you look up specialty chemical stocks, for whatever reason, they've been doing pretty well lately. Technology, as you know, bottoming out here. Oh my goodness, look to the left. And so we look at those pivots, and when they're clustered together, we recognize this as an area and then see what happens when they get there. So you can see this big topping pattern that is formed. So is the decline over? Well, for the moment, yes. But could it come down here and test this again? Absolutely. The trend is down. So if it pops up into this area, I would suggest take the money or sell some covered calls, and we'll assess how things look. Internet, just weaker. It couldn't even get up above the 20 MA or the pivot. So this continues to be a weak sector, and just looking at things in a simple way, is it above or below the 20? This is not. Did not get up to the pivot. Where we look at other things, right? Computer software, that got above the 20, and that's been weak. Semiconductors, that had got above the 20, but yet internet, it's not. Relative weakness. Solar, bit messy, but if you go to the weekly time frame, looks pretty darn, well, I should say looks pretty darn okay. We're the retest pattern down here, and it started to show some relative strength early on, so that still looks good, even though the daily is a little messy, but it's above all the moving averages. It closed above the pivot. It's got room to go up. That looks good. Gold may start to find a bottom here if the dollar continues to pull back. All right, it came down a whole heck of a lot. Stabilized for now. If the dollar continues to pull back, gold should find buyers. And gold miners, got a bit of a sell setup here. But if the dollar continues to pull back, that should fail as a sell setup. Interest rates, we looked at the 10-year and the 5-year. But this is TBT, and you can see how it's rolled over. But it's at some support. So let's see how it holds there, if it turns back up or if it moves back down into this area. In any event, we see where the dollar is, where interest rate is, those instruments that helped push the market lower. If they flip back up, it could make for at least a choppy market environment and potentially give us that correction bar pattern that we want. Marijuana continues to be in a downtrend, little to no support, so stay away for now. At some point, we have to believe it's going to come back Just we'll see how the pattern plays out. As always, any questions, email myself, Greg at Master Trader, or Dan at Master Trader.